Look, the biggest mistake you can make as an investor is making reactive emotional trades based on every news headlines. One day the market is up on a rumor, the next it's down on a tweet. It's exhausting, and it's a surefire way to bleed your portfolio dry. The solution isn't to ignore the news. It's to understand the machine behind the curtain, to see how a policy decision in Washington connects to a data point on Wall Street, and ultimately to the value of your retirement account. And if you're short on time, here is the single most important takeaway for the week ahead. The Federal Reserve is looking for any good reason to cut interest rates. But President Trump just dropped a 30% tariff bomb on goods from the EU and Mexico. This move could easily push inflation higher, tying the Fed's hands. So, the earnings reports from the big banks this week are no longer just numbers. They are the first real damage assessment. Alright, for those of you who are new here, my name is DataCat. And no, that wasn't my name in my previous life. For years, I was an analyst tucked away inside a Fortune 50 company, spending my days swimming in spreadsheets and models, trying to make sense of it all for the people at the top. I eventually traded that corporate grind for, well, lasers and keyboards. My new boss is a cat named Chairman Meow, and his performance reviews are mostly just silent, judgmental stares. I started this channel for a simple reason, to stay cozy at home and not to work any, sorry, my bad. What I mean is that most financial news is just noise. It's designed to get a click, to make you feel like you need to do something right now. My goal is the opposite. It's to give you the data, connect the dots with clear reasoning, and help you build a framework for your own decisions. No hype, just the signal. So, let's get into the signal for this week. We have to start with the Federal Reserve. You can think of the Fed right now as being in a really tight spot. The story for months has been about when, not if, they will cut interest rates. Lower rates make it cheaper to borrow money, which stimulates the economy. This directly affects your mortgage timeline, the interest on your credit cards, and the growth environment for the stocks in your portfolio. But the Fed itself is not a monolith. It's a committee, and right now, that committee is deeply divided. This isn't just a general feeling. You can see the mixed picture in their own words. This week alone, we have 12 different Fed officials speaking. You have Governor Christopher Waller, who gets into the technical weeds, recently discussing the flexibility of their balance sheet, a subtle way of signaling they have tools they can use. Then you have Chair Jerome Powell, who in his recent testimony to Congress stuck to the main script. They are data dependent. That's classic Fed speak for, we are not committing to anything until we see the numbers. And then you have Governor Michael Barr, who keeps reminding everyone of the Fed's dual mandate. This is key. They have to fight inflation, yes, but they are also tasked with pursuing maximum employment. He's essentially highlighting the tightrope they have to walk. That proof comes from key economic data. This week we're getting a flood of it. First up is the Consumer Price Index, or CPI. This is the most common measure of inflation. It tracks the average change in prices paid by you, the consumer, for a basket of goods, from gasoline to groceries. Forecasts are for it to tick up slightly to 2.6% year over year, while the core number, which strips out volatile food and energy, a bit higher at 2.9%. We also get the Producer Price Index, or PPI. This one is important because it's a leading indicator. It measures the prices that producers get for their goods. Think of it this way. The PPI is the cost of flour for the baker. The CPI is the price you pay for the loaf of bread. If the cost of flour goes up, you can be pretty sure the price of bread will follow. The market is expecting the PPI to rise, which suggests those price pressures are still in the system. This is the delicate balance the Fed is trying to manage. They want to cut rates to help the economy, but they can't do that if it looks like inflation is getting a second wind. Now, just as the situation was getting complicated, the government decided to, toss a live grenade into the room. On Friday, the US announced a sweeping 30% tariff on all imports from the European Union and Mexico, starting August 1st. This is positioned as a move to rebalance trade, but the immediate effect is that it makes a lot of things more expensive. We're talking about cars, pharmaceuticals, machinery, and even some food products. Businesses that rely on these imports now have a massive new cost. And what do businesses usually do when their costs go up? They pass them on to the consumer. You. In simple terms, we're still stuck in an artificial dilemma, a classical Trump's move to stir the market. This tariff action pours gasoline on the very inflation fire the Fed is trying to put out. It complicates everything. It puts the Fed in an almost impossible position. Do they keep rates high to fight this new wave of potential inflation, even if it hurts the economy? Or do they cut rates to support the economy and risk letting inflation run wild? It's like the economy was a cat cautiously trying to walk across a narrow fence, and the tariffs are a giant cucumber suddenly appearing next to it. The reaction is going to be unpredictable and messy. So, how do we get the first clue about how this story unfolds? We look at the canaries in the coal mine, corporate earnings. This week, the big banks, JP Morgan, Wells Fargo, Citigroup, all report their second quarter results. Banks are the circulatory system of the economy. Their health tells us about the health of everyone else. I'll be ignoring the headline earnings per share number and looking deeper. I want to know about their loan growth. Are businesses and people still borrowing? I want to know about their net interest margins. Are they actually making more money on their loans? And most importantly, I'll be looking at their provisions for credit losses. That's the money they have to set aside because they think someone isn't going to pay their loan back. If that number starts to climb, it's a major red flag. Beyond the banks, we get a read on the tech sector from chip giants ASML and TSMC. As you should know by now, the AI boom has been the one unstoppable force in the market. Do their numbers show that this force is strong enough to power through these new global trade headwinds? And finally, we get a look at you, your spending habits. Companies like Pepsi and Coca-Cola will tell us if you're still buying the simple luxuries. And Netflix's subscriber numbers are a fantastic gauge of discretionary spending. When money gets tight, is that subscription one of the first things to go? These reports give us the ground truth. At last, what does this all mean for your portfolio? How could this play out? Well, here's one direct potential scenario. You could see a potential equities rally if upcoming economic data and earnings reports hint at economic resilience, despite the inflationary backdrop. If the big banks and industrial companies come out and signal that they can absorb these tariff costs without major damage to their outlook, it could give the market a burst of confidence. On the other hand, the fixed income markets, meaning bonds, are likely to see a lot of volatility. Any sign of weakness in the earnings reports could strengthen the argument for a rate cut, sending yields lower. But any hint that tariffs are pushing inflation higher could do the exact opposite. The uncertainty around global trade tensions is the dominant factor right now. The key is to watch how these pieces connect. Don't just read the headline about bank earnings. Ask yourself, how do these earnings reflect the new reality of the tariffs? When a Fed official speaks, listen for how they frame the problem. Their priorities will tell you a lot about their next move. That's the data for this week. I'm DataCat. My job is to sift through the noise so you don't have to. If you found this breakdown valuable, you know what to do. Stay sharp, and remember, always land on your feet.